Good morning. I thought okay, so it's 11:02, and I want to thank everybody for joining us this morning. And we're going to give you a high-level overview of why your company should be an S corporation as opposed to other entity, and we'll talk about other entity structures. But more importantly, why an S corporation and how it saves money and how it sort of works. So I just want to introduce myself. I'm the managing director of Nathan Accounting Group and the innovator of Springboard, as you can see right there on the slide. And if you have any questions, please call me at 860-677-5001 or email me, and see the email address there. Any questions whatsoever, and also I would be very happy to send you the presentation after the presentation. So what is Springboard? So it's an all-encompassing financial suite of services. It'd be best described by outsourcing the solution for business. So we're like the financial arm of any business. It would be the CFO, the controller's duties, the accounting duties, the bookkeeping duties. We would interface with payroll. And probably the unique thing about Springboard is it's real-time information for owners. So that real-time information would consist of a dashboard for the financial and non-financial key performance indicators, things that we refer to as Kpis. And these are the essential pieces that businesses need in order to operate their businesses in a very efficient manner and try to get to their goals quicker. It keeps them on track. The last thing I'd say about Springboard is that Springboard, we don't just consult, we actually get stuff done. So why should your company be taxed as an S corporation? And the two top reasons. The first is by far the biggest, and that is saving self-employment tax. We've been in business here for 30 years, and we've created and helped people create and elect S corporation status. We've probably saved hundreds of thousands of dollars for our clients, if not larger than that. We don't keep track of that. But in certain cases, we could save $30,000, $40,000 a year, every year, with S corporation status, all due to this first line, saving self-employment tax. And the second reason that people should be taxed as an S corporation is they could avoid double taxation. And this is primarily the case if you're a C corporation, because C corporations have double taxation, but C corporations also have the ability to elect S status, and we'll get more into that in a second. So in this webinar, the next 30 minutes or 25 minutes, whatever we have here, we're going to answer a few questions, right? So the first fundamental question is, what is an S corporation? And I think that's important to understand the basis of that. Second question that we'll answer is, what types of entities can become an S corporation? And that's kind of a cool thing, because you don't necessarily need to be a corporation to be an S corporation. And so there's some legal structures we'll get into that will illustrate how easy it is to become an S corporation and get the benefits of the self-employment tax savings. And how does one become an S corporation? I think I kind of said that as well. And of course, I will show you the way to save tax dollars by the time we're finished here. And if you don't see the tax savings by then, call me. But I think it'll be pretty evident. Last thing I want to say is, if you have any questions during this webinar, do they have the ability to type that in?
They can go ahead and chat right here too. So there's a chat button.
Yeah, so feel free to email me questions, and Ankeny right here will relay those questions to me. So what is an S corporation? So historically, the IRS, a word that we never really like to use, allowed businesses that are set up as corporations to elect S status for tax purposes. Then the reason for that is corporations C corporations pay its own taxes. It's a separate tax entity that pays its own taxes. And it was thought that S corporation, or what they gave us was subchapter S in the Internal Revenue Code. And in subchapter S, it allowed a corporation to pass its income to its separate owners. And for that, they got the avoidance of double taxation. It's more recently, I would say the past 20 years, that LLCs were also allowed to elect S corporation status. So that's the history of it. Therefore, what we should take from this slide is that an S corporation is a tax status and not a legal status. It's a tax status. You can't go down to your state Secretary of State and say, hey, I'd like an S corporation. You really need to take out an entity and then ask the IRS or elect with the IRS a tax status. So we'll go from there. All right, so what types of entities can become an S corporation? And you can see from the chart on this page that that an S corporation could be elected in the third column, the right column, for certain entities. The legal status, you're an individual and you have a business. It could be a big business or small business, but you decided not to do it with a separate legal entity. For that, the tax status, which is the default status, would be a sole prop, and that would be filed on Form 1040, Schedule C. You can see it right there on the first line. Second line says, if you're an LLC, you went to the Secretary of the State and you said, hey, I'm an LLC, I want to be an LLC, and you're the only member, the default for filing your tax return or your tax status would be the exact same thing, sole prop, Form 1040, Schedule C. It is a single member LLC that the IRS doesn't even recognize as a separate tax entity, and that's only for tax purposes. So for tax purposes, the legal entity is the LLC, but it's disregarded. It's a technical term that we use. It's disregarded for tax purposes, therefore you'd file on Schedule C. But the IRS also said, since we don't have tax code written specifically for LLCs, we're going to allow you to elect a different status. And so they allow you to elect either S corporation or C corp. Very few will elect C corp because of double taxation, and they won't get the benefit of not being able to avoid taxes on self-employment taxes. And then multi-member returns. So an LLC with more than one member, the default is to file a partnership return, Form 1065, or again, the election, just like with a single member, they can elect either S corp or C corp. So again, for the same reasons I said above, there's benefits to doing S corp over C corp. Sometimes, and technically, an S corp can only have 100 owners, so sometimes you need to go to C corp. But with less than 100 owners, S corp is certainly the way to go. There are other limitations on what can be an S corp, but probably a higher level class than this one. Partnerships usually file a partnership 1065, and if you go to the Secretary of State, you might be able to get a limited liability partnership. There are other entities, but all the partnership type entities will file a Form 1065. No election, there is no election for different tax status with that legal entity. And a corporation, which is the legal status at the Secretary of State again, the default is certainly filing an 1120, and the election is an S corporation. It also says an election for C corp. No, the C corp would be, that's a typo. The C corp would just be the default. The S corp would be the election. So you could elect to be an S corp there as well. And so many of our clients that are corporations will elect S status for the savings we'll discuss here. Let's see. So next slide. Having technical difficulties. I have it here. Talk to it. Okay. So with the next slide, we actually, can we skip the slide? Okay, so that's legal status. So in the very next slide, what we're talking about here is how you save money. We said at the top of in the intro that we were going to show you how to save money. So from this slide, what can I show you is that in a partnership or a sole proprietorship, so it could be either one, the profits that are earned by that entity, the net profits, bottom line profits, that is revenues minus expenses, is $200,000. Because you're either a sole prop or a partnership, you're not allowed to take salary. And with that, you have to pay self-employment taxes. It's a very stealthy kind of tax. It shows up on the second page of your income tax return on your 1040, and it's usually a very large number. In some cases, it's larger than the income tax. And so if you're a partnership or sole prop and you earn $200,000, you could see that your self-employment taxes would be $21,573. Technically, though, you're going to get a deduction for half of that, so your net self-employment taxes will really be $18,553. So, as corporation, and the prime subject of this webinar is you have the same profits. That is the same revenues less the same expenses, and you have a $200,000 profit. From that, you would take a $60,000 salary. The remaining profits, $140,000, will find its way to your individual tax return as well, because this is a pass-through entity. So both the 60 and the 140 end up on your personal return. The big difference is that only the $60,000 will attract self-employment taxes. You'll only have to pay self-employment taxes on the salary of $60,000. So in this case, the SE tax is $9,180, and the net self-employment taxes, that is the deduction for half the self-employment tax. I didn't put all of that on the slide to keep it very high level and simple, is that the net self-employment taxes for the same $200,000 in an S corporation that pays its owner $60 is $7,895. The difference between the partnership sole proprietors and the S corporation is a savings of $10,658. So you could see that there is, if you will, a nice loophole in tax structure. And so this is a very, very simple illustration. If you had less profits, you might save a little less if your salary is the same. If you had more profits, your savings would be much greater. We have an example of a doctor who has $1.2 million of income. They used to be a sole prop until they came here. We asked what would be a reasonable salary. Very important. I'll get into the reasonable salary in a second. How much would you take if you were paying yourself a reasonable salary? So we converted that person, elected the S corporation status. She takes a $200,000 salary, and so $1 million, 1.2 less $200,000, $1 million avoids self-employment taxes, saving about $30,000 each year. So that's just one fantastic example of savings. But this certainly works all the way down to what would be a reasonable salary. So if you have an income of let's say $70,000, but a reasonable salary would be $60,000, this may not work as well because the savings would be much less. So that's where the big savings are.
Do you want to hold questions to the end, or can I ask you a question now?
Oh, we can ask questions now. Sure.
So a question came in on S-Corp.
Yes.
And wondering if you have to have a partner to have an S-Corp. Start with that, part one.
Yeah, part one. So the answer to that is you don't have to have a partner to have an S-Corp, but you do need a legal entity. And the only way to have a legal entity which has one partner would be an LLC, and that would be considered a member. So if you went back to the earlier slide, you could see from that that an LLC could elect S status, or if you were a corporation legally formed in your state as a corporation, that corporation, so the only owner, you don't have any partners, you can also elect S status at that point in time. So you can become an S corporation for tax purposes at that point in time. Does
that covers both questions. The other piece was about the partnership. So that makes sense.
Okay, good.
Let's go on to the next.
All right. So what are the other considerations? These are kind of somewhat important. The consideration is that the income from an S corporation passes through to the individual owners with Form 1120 K1. So K1 is similar to a W-2 in that it's similar, a one-page form that will identify the items of income and items of expenses that would be put on your 1040. The nice thing about the 1120 SK1, there's a typo, there should be an SK1, is that it will not come with self-employment tax. The income will not create self-employment taxes on your individual tax return. So that's the beauty of that. The second point here that I really wanted to speak to is the amount of reasonable salary taken by an S corporation owner governs the amount of savings. So this is taken two ways, right? Firstly, if your reasonable salary is lower, then you will probably reduce your ability to take pensions, and I have a bullet point down there as well. So if your income is, if you have a reasonable salary which is higher, you'll be able to get more pension benefits through Social Security, and you'll be able to get more pension benefits. The idea of this first bullet point, though, is the lower your reasonable salary, the more you actually save in S corporation self-employment taxes. So most people want to reduce it as far as they can. It's the IRS that comes back, there's that nasty word again, the IRS comes back and says, hey, wait a minute, it needs to be a reasonable salary because what they're trying to do is essentially stop abuse, right? So if your reasonable salary for a person in your position for the hours that you work it should be, in the example we've shown before, $60,000, and you're only taking $30,000, they could come in and exchange some of that tax-free monies that were not subject to self-employment tax and make them subject to self-employment taxes. So reasonable salary is kind of important, but not that difficult to actually achieve. You could look at other people in your industry to find out what reasonable salary is. So that's a very important concept. Every S corporation is allowed only one class of stock. It's just one of many things that the IRS limits an S corporation to have. So, and an example of that is really the next bullet point. So if you have more than one owner, it is critical that both contributions and distributions to the owners are based on their percentage of ownership interest. If you don't do that, if you don't, so a capital call is needed. You need additional money coming into a enterprise, which is an S corporation. That needs to come in on a pro rata basis. Otherwise, it's considered a preferential treatment of one owner over the other, and the IRS says that's two classes of a stock, and therefore they will terminate your S election, and then it might have other consequences. So if you have one owner, that never comes into play in terms of creating two classes of stock. So it's very important that all contributions and distributions by all owners are equal to their ownership percentages. And just going over the next bullet point, which we've sort of covered, that if your wages are limited because you want to save money in self-employment taxes, you will also limit your, could also limit your Social Security benefits when you retire, and your pension contributions may be limited due to the fact that your wages are a little smaller than they otherwise could have been, or your earned income otherwise smaller than it should have been. Last bullet point on this slide is, and I think one of the sort of bigger benefits, not necessarily dollar savings, is that you actually, with an S corporation, if you are a sole prop, as we've shown in an earlier slide, your information actually shows up on Schedule C on your 1040. So if the IRS comes calling, they will want to see your entire tax return. With an S corporation, since it is taxed separately, it reports separately. Obviously, it's taxed on your personal return. Since it reports separately, all the business income and expenses are shown in a separate tax return, thus getting the information of the business off of your personal return, therefore less scrutiny of your personal return by the IRS. So,
with that said, I think we're talking to a lot of businesses that are probably LLCs.
Okay.
And their tax status is as such, and they may want to switch to an S-Corp tax status. What do they need to do in order to make that switch?
Yeah, good question. So if you are LLC, being taxed either as a partnership or being taxed as a sole prop, it's a very simple form. Fill out one form. One form is a Form 2553, and oh, sorry, I'm looking at, thank you. Yeah, so it's Form 2553, and it's a 3-page form. Typically, 2 pages are filled out. The form needs to be signed by authorized signer of that form, but all the other owners also need to sign the form because it does need unanimous consent. Okay. Good question. So it's a very simple form. We can fill them out here, or we could show you on the IRS website where the form is. Okay, so that's the high level overview of S corporations. I'm not sure I left anything out.
Can you touch on Springboard and how Springboard works with LLCs or S corporations?
Sure. So in the model that Springboard is set up, since it is the financial arm, Springboard will help govern and determine entity for its clients. So with that said, if you're an LLC and you come to Springboard and you say, hey, can you help me? We will look at not just how to file, an entity going to S, showing what an S could save. We would also do the accounting for that, the bookkeeping for that, and other. The thing about Springboard is, sure, you're going to get the best of the entity's decisions on best of entities, but you're also going to get other financial decisions that are equally as good. Which payroll company to use, how to integrate payroll information into accounting software, whether it be QuickBooks, Peachtree, Mass90, whatever it is, we can help with all of that. And then to marry all of those things, give a dashboard to our clients, which will help them run their businesses, so they could see. We talked about it, touched on it earlier. What are financial KPIs, key performance indicators, and what are non-financial KPIs? So a financial KPI is what's cash looking like? Can we project cash out? Those are very important questions. But equally as important, how many hats do we need to produce today? We're an embroidery company, and we need to produce hats. How many hats do we need to produce? How many stitches should those hats have? So a KPI, or a key performance indicator, is that we need to produce 5,000 hats today to break even. We will help and that's a very simple illustration, we'll help our clients determine what those are. And also at Springboard, we hold our owners accountable so that we are partnered together to make sure that they hit their goals. And if there's any roadblocks, we help them free up those roadblocks. If there's any bottlenecks, we clean up bottlenecks. So we are the information, financial information for businesses. That's what Springboard does. So it's not just what kind of tax entity, it's also all the other pieces.
Well, thank you so much, Alan, for taking the time to share with us about S corporations and Springboard.
Sure.
Do you want to let everyone know how they can find out more information about Springboard, what website to go to, and how to contact you? Again, just a quick recap on that.
Oh, sure. So if they want to contact me, my number is 860-677-5001. Little brain fart there. My email address is anathan@nagcpa.com. That's NAGCPA.com. And if you ask for the slide, you could ask for the slides there. We'll get that to you. It was in the first slide. And they can go to My-Springboard.com with a hyphen, so it's my-springboard. My-Springboard.com, and they can learn more about Springboard as well. And if they have any other questions, we like to think that we're out there to help the community. So if there's any other questions on other types of entity or how will their situation really fit into an S-Corp, or would it be better off being a partnership, we'd be happy to answer all those questions as well.
Thank you very much.
And I want to thank everybody on the call as well.